This is actually the first of our Wedge Plus training education modules that will appear in HIFX University for Wedge Plus. And the very first one we're going to start with kind of makes sense for those of you who are already getting the wedges and doing something with them. And that's understanding how to read the wedge alert itself and why it's constructed the way it is. So it's important to understand that. It will help eliminate questions as we move forward. All right, so first of all, there's two sources for notification of the wedge alert itself. The first one is where it's actually posted, and that's in Facebook. And I've got a screenshot of one of our recent ones there. And then on the left is a screenshot from my Telegram, where we also announce, as you can see, the ID number for the wedge alert and just the fact that a new 15-minute wedge was posted in the Facebook group. So again, this is for security reasons. We don't have all the info in here because I've seen where that just gets passed around. All sorts of people in those Telegram groups that don't belong there, etc. So if people find their way to this Telegram group, it's not going to do them any good, to be honest, because it just points to the fact that there's a wedge alert in the Facebook group, which has security. So you can put yourself on notifications for both of these. I would do that. We're not in the business of doing 50 of these wedge alerts a day because we're looking at wedges that have some good potential. We'll talk about that. And they're going to take their time to form, and for the most part, not always. In this particular case, this wedge alert, as you can see in the middle of the screen, was posted in such a way that there was a command at the very top that says, "will breach soon." That's because we're at the end of a tighter wedge. Now let's look at the data inside that wedge. So the first thing is that significant important statement. That will only appear infrequently. You won't see that on every wedge. That's just a note that says, hey, this is significant. Pay attention to this. It might breach soon. All right. The Wedge Plus ID number. So obviously Wedge Plus in the year 2020, this is number 32. And so when we get to 2021, we will start the counter over again. And the reason you don't see all those wedges is because when we started the counter system, we were beta testing everything we're doing for several days to make sure we liked what and how we were presenting the information. So anyway, that gives the serial number. So it'll always be referenced, etc. The next line, you'll see wedge new. There'll typically be 3 comments there: new, update, or results. And so the new one just says wedge new. The ID number remains 00032. When there's an update to it, it will be named W2030 WP20-0032-U for the update and WP20-0032-R for the results. So we will be posting updates. The update may say wedge breached, might say something else. The results will be, you'll see we're going to be doing things where the results are first given with standard education, and then we'll have a second set of results for using HIFX 33, which is a harmonic wave convergence indicator specifically for your wedge trading. All right, so that's the wedge ID number, and that's the wedge status, if you will, information line. Pairs, pretty simple. What of the pairs? We will be tracking the 8 majors plus Euro Pound plus gold plus Bitcoin, and we may deviate from that, but that's going to be the basics, and we'll cover that in the first day of wedge training as well. I will say this was designed to be a quick and dirty in and out, just a review of what you need to know about the wedge alert information. There is a little bit of teaching included because I can't convey everything you need to understand about the information in the wedge alert without a little bit of teaching or refresher for some of you. Time frame. We're only going to be dealing with 15-minute wedges and wedge alerts and 4-hour wedge alerts. Sometimes you may see, depending on the nature of the wedge, that wedge represented on a 15-minute chart. And there's reasons for that. And that's because the HIFX 33 indicator is 15 minutes and below. And so we want to give as much opportunity to be able to use that indicator as we move forward. And please don't be asking about it. We're going to talk about it starting later next week. So we're going to get some basic training first on the standard ways to trade wedges. So time frame will either be 15-minute or 4-hour for the nature of the wedge, and more so the chart that we're posting. Chart time zone. Well, this is an interesting thing. So technically, from a global standpoint, the currency market is open 24 hours a day. However, there has to be a virtual close because you need an open, high, low, close candle. You need open data for the day, high data for the day, low data for the day, and close data for the day in order for many of the trading indicators to work, because they are built on daily ranges. What happens inside the daily candle. And if I'm using 5 p.m. Eastern and you're using midnight in Moscow, and somebody's using 3 p.m. in Hong Kong because that's where their broker's server is, it's hard for those formulas. Therefore, your indicators are going to read different that use open, high, low, close on a daily basis. Your indicator is going to read different if your day goes midnight to midnight, if your day goes 3 p.m. to 3 p.m., or if your day goes 5 p.m. Eastern to 5 p.m. Eastern. So there's an internal standardization in the Forex to have the day end at 5 p.m. Eastern. And so it's just a good thing. We have to standardize on something on your charts. You might feel so comfortable having local time, but that doesn't help when somebody in California is watching you talk someday or watching you talk about your charts, and you said, oh, my 11:30 candle did this, and now they've got to what? Go to a global clock and try and translate what time zone you're actually using for your charts in order for them to understand which candle it is on their chart, etc. So we don't do stuff like that. We all stay on one time zone. Your chart should be set to UTC -4, which is indeed US Eastern. Just the way it is, just the way you're going to have to understand what's going on our charts. So we have something called the yellow line on the chart. And the yellow line is a representation of when we drew that wedge. Okay, when we drew the wedge. And so that's important for you to know, because you want to know when the wedge was drawn versus, oh, here's a wedge that's already breached, right? So we're definitely interested in you saying what time we drew the wedge. Doesn't always mean we're going to post it right then, but it will be included in our chart. So as you can see here on the right, in this particular wedge, the yellow line is there, and as you follow the yellow line down on TradingView all the way to the bottom, you will actually see the date and the time in Eastern on a 24-hour clock. So that number there then gets represented in the alert. And if you look on the alert, you will also notice it's 2010-14 at 13:15 Eastern, which is the exact same number you see on the chart. That's why it says the yellow line time. So yellow line time represents when we drew it. Also in this example, you will notice the yellow line at the top has a -1 next to it. And that means that -1 means that line really belongs one candle to the left when the wedge was drawn. But if we put it there, you wouldn't see the wick touch on the wedge. So we move it one to the right and we put -1 at the top, was just telling you that line, when we actually drew it, was one click to the left. On a 15-minute chart, that would make the yellow line really at 1300, right? But we're going to post what the yellow line said. So if you see a -1 there, just know that we drew it one candle before then. So in this case, somebody was watching their charts, and when it actually connected on this line again, that's when they created the wedge. So pretty timely information. Okay, that's what yellow line is. We then have the time of the post. So we get that within a minute or two. You know, we're doing some things, we're adding some things, we're filling out information, and you know, we guesstimate that the best they can. We know what we're doing now, and so we can say, yeah, I got about a minute more here of data to work with, and then I'm going to post it. So we'll say 1304. So it might be 1304, it might be 1303, it might be 1305, but it's within 30 to 60 seconds of whatever we say there. Okay, that's the actual time of the post in the Facebook group. All right, data feed. Now, this will create some issues here and there, infrequently, but I'm just going to be transparent. They will be there. And what I'm saying by that is sometimes the data feeds between brokers are off just a little, to where your candle may actually be a pip higher. It might be 2 pips lower. Okay. For the most part, and we've done some data analysis. Actually, we've done some data collecting. We haven't analyzed it yet, but we're in the process of doing that to see what the variances are and how much it makes a difference. Okay. And when that's done, we'll talk about that a little bit more in the training. But right now, just understand we list the data feed, and that's because if you go to draw your wedge and you draw your wedge, and as you've drawn it, the wedge has been breached by a candle in between 2 points, that probably means there's a difference in the data feeds. And I wouldn't worry about it too much, depending on who your broker is. And again, we have lots of time to talk about that in trading. Here's what I'm going to tell you. So amongst the people doing the wedge spotting identification, and right now we have a panel of 3 that review the wedges that are identified. So when the wedge is identified and everybody agrees on it, we look at it, and sometimes internally we use different data feeds depending on who's looking and who's identified. I would say maybe 1 in 20 wedges isn't really a wedge based on one of our data feeds. Okay. Which means we may show a wedge, and as I said, you put it on your charts, and you might have a candle between 2 points where a wick breaches it by a couple pips. For the most part, I would say don't worry about it. Or if you draw it that way and you choose not to trade it, that's trader's choice. If you're not comfortable with that, that's fine. I personally, inside my own broker, inside my own data feed, I don't trade wedges that are breached, and there's 1,000 reasons for that. I know another company, when they started teaching wedges, they didn't care if the trend line cut through a candle or cut through a wick. It's not a trend line if it does. Okay, it's just that simple, not one we want to count on. So we're going to be wick to wick. We have to have pretty much precise touches. If we have a 15-minute wedge and we're looking at our scale, and it's a 10 pip scale on our charts, our grid, and we can look and see, oh, this wick, I can see a little tiny bit of black space between the wick and the actual boundary of the wedge that we've already drawn. We're not going to worry about it. I mean, a half pip doesn't bother us. That's a touch, okay? But the touches may be different. Again, we've noticed just with U.S. brokers where the feeds can be a little, crazy. One thing we may do, just depending on how it goes right now, I don't have an empirical study. We're just going with anecdotal, what we see, what we remember. But if we see too much variance between data feeds, then we may centralize on one. Right now, we're not going to do that. And the reason we include a picture is so you see which wicks to connect your wedge to. And what I'm going to tell you is don't worry about it sometimes if you're connecting, end to end, wicks are higher or lower than what we have in terms of price by a pip or 2. Just draw your wedge. Okay, draw it as we have it, connect those particular wicks. It's the same thing when we work with harmonic pattern scans and we go to the harmonic pattern source and we bring those scans over to TradingView. If they're off a pip or 2 on one of the swings, we don't care. It's the essence of the pattern It's the essence of the swings on our chart that are going to determine what happened for us. And so, as I always say, with pitchforks, with harmonic scans, if two traders are there and they have different feeds, and sometimes one has a wedge and the other doesn't, or sometimes one has a fork or a harmonic pattern and the other one doesn't, don't worry about it. By the end of the year, 95% are going to overlap in one way or another. At the end of the year, the money that could have optimally been made is going to be within 5% of each other anyway. So it's not that big of a deal. All right. So don't get all frustrated by sometimes a wedge we have not being there for you. Just move on. Okay. Just move on. There'll be plenty. We're going to have hundreds and hundreds of wedges this year, you know? All right, TP1 and TP2, you might have noticed these in these wedges. Now, we are not an analytical firm. This is not a forecast on our part of what the wedge is going to do. As you will learn in your trading, there's a standard way that people in the wedge trading business can measure trades for money management, and it's called a stick. And the stick happens to be the height of the wedge, height, depth, however you want to call it, from the highest point to the lowest point. And we measure that, and we put that stick on the actual chart that we post. The TP2 is going to be the 100% stick. And TP1 is going to be 50% of that. And you'll understand why we do that in our standard trading. So anyway, that's where those come from. We're not a forecaster. These are not signals to enter a trade. These are just estimates of the potential for TP1 and TP2 based on an industry standard way of measuring wedges. They have nothing to do with our recommendation for a trade. So as you can see in this particular wedge post, at the back end of the wedge, there's the big stick, which represents TP2, and the smaller stick, which represents TP1. And there you have the pippage that they correspond to on your alert information, which would be in this case 74 and 148 pips. All right, so one thing that you're going to get or have been getting that you don't get anywhere else with wedge alerts, including most of the stuff we've already provided, is we're very specific traders with pitchforks and tridents, median sets, best fit pitchforks, etc. We'll put that data on the chart if it's relevant. Most of the time it is, because we're also most of the time including harmonic pattern information. But we'll tell you what the fork is, how it was generated. In this case, it says 15-minute best fit as shown. So it wasn't an Andrews pitchfork. Now, I know this doesn't mean a lot to some of you. Those of you who will be taking the Tridents course as we evolve it will find this very interesting, and your trading results are going to go way up once you learn how to use forks. They have a unique fit with harmonic patterns and wedges, and you'll see that as time goes on. So if there is a fork that is relevant with and around the wedge, we'll typically have that on the chart. And again, not always, I said typically. And, if it's an iffy fork, we're not going to post it. If it's something that may be significant to what's going on, we're going to post it. And that will lead people who are getting wedge alerts, that will lead you to better money management once the wedge has been broken and price is moving. And as we'll learn in our education modules for Wedge Plus, there'll be 3, 4, 5 different money management systems you can choose from in order to manage the trade once you're in it, in order to optimize without psychological damage, how to optimize the profit in that wedge trade. So anyway, if there's a fork, we'll show it. Likewise, if there's a harmonic pattern, we will list the pattern. In this case, it was a harmonic scan. It was a 4-hour bat. And that would show on the chart. If we don't have a harmonic pattern on the chart, that's just going to be blank or none or no. For both the fork and the harmonic pattern, I said consider HIFX 03. I don't want to make this a sales pitch. I'm just making it a common sense trader pitch. The weekly setups that are going to start next week, which include daily 8-hour and 4-hour, will include also through the week what I call pop-up 30-minute setups. And most of those 30-minute setups are going to include Elliott wave counts on the setups, which will again further help you. We don't trade waves. We don't trade Elliott wave. Oh, I'm in a 2 wave. I might as well just buy and write it to the 3. We don't trade Elliott wave, but it is one of those stacking probabilities that if you have a fork and a fork bounce off the bottom, and that is identified as a retrace, it's a retest of the fork, and that looks like a 2 wave, and you see the 2 wave identified on the fork, and the median. Oh, there's the projection for a 3 wave. It just adds some interest because it's independent. These are different technologies that get layered. And so when you have an Elliott wave count, when you have a harmonic pattern, when you have a pitchfork, you really have a strong sense of what's going on the charts. Now, again, we do not want to assume anything is happening. If you assume, you're giving your subconscious mind, your crew, inside that RAS mechanism we talked about yesterday, for those that were here yesterday, inside that RAS mechanism, if you give it an order, it's going to follow through. So if you make the assumption price is going from one place to another, it's going to damage you, because sometimes it won't go that way. And the things that show you it's not going that way, you've screened out because you've told your crew only look for this particular place it's going to go. So this is why, when you see newer traders and even sometimes supposedly seasoned traders doing arrows on their charts of where they think price is, it's going to pull back here, and from that pullback retracement is going to bounce here. That's mostly ego fulfillment, and it's the worst thing a trader could do, because it's programming your mind to actually screen out the things that'll show you it's not going to do that. And you want to know if something's not going to happen. So you don't want to get too firm with what you're doing, and be careful how you see pitchforks and harmonic scans and Elliott wave. But the 30-minute pop-ups are going to be very helpful for wedge trading and any other trading that you're going to do, because again, they will have relevant information: scans, forks, Fibbo, Elliott wave. And so it's going to be a very powerful thing for $5 a week. I mean, literally, give up one of your days at Starbucks. Get the blasted setups if you don't have them right now on subscription. All right, what else? Wedge strength. Now, this is really cool. You will not see this anywhere else. This only comes because wedge traders understand the technicals of what a wedge really is, and how to put probabilities on whether I want to mess with this one or just wait for a better trade. Okay, it's stuff AI can't do, because AI doesn't have trading experience, and even if it's machine learned based AI, they're going to have to go through thousands and thousands of examples in order to be able to do anything close to what we're doing here. And so this is a very, very unique feature. Not that what we have already isn't kind of unique, but this is a very unique feature of what we have going on inside of Wedge Plus. So let's talk about wedge strength and what it really means. You'll notice there's 2 numbers there. In this particular one, this is not a fabricated alert. This was an actual alert. You can go back in the Facebook group and find it. It says 5-4. Let me tell you, that is very unusual, and that is a very cool thing to trade if you see a 5-4 there. Let's look at where this number comes from and what's really happening here. So this is a little side bit of teaching that I have to go over in order for you to understand that number. And since that number is included in the information of the wedge alert, you need to understand what it is. But I guarantee you're not going to find this thing anywhere else. So really, when it comes down to it, what is a wedge? All right. Now, I've taught wedge courses before, and advanced wedge traders will learn to look for specific patterns inside the trend lines that define a wedge. Okay, they're Elliott wave patterns, and you have triangles, and you actually have zigzags, or are very often referred to as descending and ascending triangles. There's very specific patterns with very specific wave counts in these things. But when it comes down to it, a wedge is nothing more than 2 trend lines which are contracting. Okay, so here's a trend line from a top side, and here's a wedge line from a bottom. Okay, and you'll notice they're just 2 trend lines. And again, a wedge is nothing more than 2 trend lines which are contracting. When you learn the patterns, you're going to know much more which way the wedge is going to break before it breaks. So it does become of interest to become familiar with the patterns, because they will tell you with high degrees of accuracy in the upper 90% which way the wedge is going to break. And if you know that before the wedge breaks, we'll cover that in our training. So a wedge is just two trend lines. So essentially, trend lines have strength. So the fact that it's a trend line and two trend lines contracting can create a wedge, it's still important to understand that trend lines have strength. So let's look at this trend line here. You see 3 red arrows for 3 particular touches on the trend line. What's the challenge then? What defines a trend line? So we're saying a wedge is 2 contracting trend lines. What defines a trend line? I have 2 price points, I connect them. That's a trend line. 2 points, connect them. It's a trend line. Period. So I guess a trend line made of 2 points can be a wedge, top or bottom trend line. And that's correct. But trend lines have strength. So let's look at this example here. I've got 2 bounces represented by the red arrows, and I have a breach that comes along. So the question I have here is that really a breach? To the uninitiated, they're going to say, yes, that's a breach. I have a candle that closes outside the wedge. There's no question it's closed outside the wedge. We're calling it closing outside the wedge because it's closed outside that trend line. But is that a breach? What if that what appears to be a breach of your trend line is really just a third wick that is deeper in this case than the previous one? And therefore the real wedge is not, or the real trend line is not 1 to 2. The real trend line is 1 to 3. But if you traded 1 to 2 as the trend line, and that third candle comes along and you treated that as a breach, guess what? You're in that trade. Only to have it come down a few more pips, stop, turn around, and go up 100 pips. You get stopped out. So don't always assume a trend line with 2 points is a trend line that can be traded. This is why we include forks. This is why we include harmonic scans. What if that 1 to 2 line was the bottom of a pitchfork, the lower parallel? That brings a different kind of strength to it than it just being a trend line because it's two touches that I've connected. I hope you see the difference in that. And you will see many times when there's anxious wedge traders, they take that trade at 3 because they see it as a breach of the trend line. Oh my gosh, I got stopped out. Wedges don't work. Okay. So understand in the top of the graphic here, a breach on a 2-hit trend line may or may not be a breach. It may be a breach. It may be just a deeper push, and really the trend line needs to be adjusted to accommodate it. Skipping point 2, if you will. A breach on a 3-hit trend line after that third hit is most likely a breach. So I've got 3 hits now as drawn with that trend line. A breach that occurs after that third red arrow is a breach. Do you identify the difference between these 2 scenarios, right? So let's look at a summary of wedge strength and wrap this up. Wedge plus alerts provide info you won't see anywhere else. We're looking at both trend lines of the wedges and seeing the hits generated to create trend lines and thus the wedge. So while we're told it's a wedge, while we're told, oh, a breach of the wedge is a trade, we don't see it that way. We see the wedge as 2 independent trend lines that are just going to cross. So really, when you're a wedge trader, you are a trend line trader. Pure and simple. When you're a wedge trader, you're a trend line trader because a wedge has 2 components, a top trend line and a bottom trend line that have enough angle that they're going to cross, hopefully on your charts. And we trade one of those trend lines or the other. There's no such thing as a breach of the wedge. It's a breach of one of the trend lines of the wedge. I know it sounds semantical, but you have to understand what's happening here. Okay. So we look at those individual trend lines and we assign strength, and we call it wedge strength, but we assign each of those trend lines a strength factor. So a wedge of strength 2, 2 indicates the top and bottom trend lines each are just 2 hit trend lines. The first number is always the top trend line. The second number is always the bottom trend line. So you should be cautious of a breach on either line of a 2, 2. Let me say it again. You should be cautious of a breach on either trend line of a 2, 2, as it just may be establishing a repositioned trend line. Let's compare that to a wedge with strength listed as 3, 3, where we now know that a breach to either side is most likely a true breach. Does that mean avoid all 2, 2s? Absolutely not. I'm just telling you, if you're an anxious wedge trader and you see, oh, look, that red can, I can see red, I can see a tiny bit, like, I won't say the word, but a very tiny space between the trend line and I see a little bit of red on the other side. Oh, I'm ready to take the trade. You're going to get burned. Your percentage of wins is going to go down because you were jumping the gun. This is why we do put other information on the chart to help you understand. If it's a pitchfork bottom, it's no joke that we draw wedges and very often they align on a pitchfork, top or bottom. That strengthens that trend line. There's, and when we get through triangle, you'll understand that line has a bunch of Fibonacci-ness in it that a normal trend line doesn't have. So there's extra power, if you will, in that particular trend line that resides on a pitchfork parallel or a median. So we include that information, okay? If the wedge is drawn using swings from a harmonic scan, harmonic scans have very specific, unique qualities because they are laden with Fibonacci. The swing points are Fibonacci derived of a scan. That's how the scan gets drawn. So when we have a trend line that uses the scan swing points, even though there may only be 2, that's not the same as a normal trend line that only has 2 hits. It's a much stronger trend line. Okay? Making sense to some people. Lastly, so you should be cautious of a breach on either line of a 2, 2. It just may be establishing a repositioned trend line. Let's compare that to a wedge strength listed as 3, 3, where we now know that breach to either side is most likely a true breach. So a wedge standing out there in space, not associated with a pitchfork, not associated with a scan, there's nothing else going on, I would be very cautious about a 2, 2. Okay? A wedge that's standing out there in space and there's 3 hits on each trend line before there's potential for any breach, I'm liking that. But I also like a 2, 2 that's on a pitchfork. I like a 2, 2 whose points are coming from, an AC line from a harmonic scan. And lastly, there's one more case that creates a strong 2-hit trend line. So with wedge plus alerts, we understand that a wedge has 2 components, 2 contracting trend lines. However, while that is the case and the wedge will breach to one side or the other, one of the 2 trend lines gives up its pass status and allows price to pass. As a wedge trader, you are really only a trend line trader. The wedge is just a name for 2 trend lines that will cross. Having the preview of the strength of each line, the preview being that 2, 2, 3, 3, 3, 2, whatever it is in the alert, having that preview of the strength of each line allows you to make better decisions. Remember, we're not telling you there's a trade, take the trade. We're telling you there's a wedge. Wedges, if it's a true wedge, wedges have particular characteristics. They have very high percentages, very known targeting, etc. But you still have to judge whether that wedge really fits that description. And so we're giving you that information inside the info that's provided with the alert. The wedge is named two trend lines. Having a preview of the strength of each line allows you to make better decisions. Example, you have a wedge strength of 3-2 listed in the alert. There's the picture. You could chase down the hits, 3 on the top, 2 on the bottom. You may be more comfortable with a wedge breaches to the top versus a breach to the bottom. Hope this is making sense now, right? There's much more comfort in the wedge breaking to the top, to the bottom, in a vanilla 3-2. It's just standing out there in space, not part of a pitchfork, not part of a harmonic scan. It's just a 3-2 standing out in space. We tend to avoid the stuff standing out in the space. You'll see some, but most of the ones you'll see and have seen are going to be associated with scans and forks. That's because they bring extra strength to the situation. But this insight just is a reminder. Oh, 3-2, that means the upper line is going to be much stronger than the bottom line. If it breaches, it's probably really a breach. Makes sense? Lastly, we know that isolated scouter wicks, now isolated means there's not a whole bunch of wicks side by side. So if you're on the yen or the Swissy or a crosspair, or the CAD or the pound at certain times, it could be very wicky, what I call too wicky. And as you'll learn, what that means is the wicks are bigger than the bodies of the candle. They occur very frequently, and very often the wicks are out both sides of the candle. Or if you prefer to call them shadows on the bottom, that's your prerogative. But when you have wicks out both sides, and they're frequent, and they're big, it's not a good time to be trading, because a wick that big means rejection. And the only time that has value to you as a trader is when that wick is isolated, meaning amongst all the other candles left and right, it's the only one with that big ass wick hanging up there reaching out to touch a trend line or a support and resistance line. So an isolated big wick, I call them scouter wicks. It's like the enemy is there, they're camped on the other side of the river, so we send our scout out, and he goes way a couple hundred yards, maybe miles ahead of your current little squad, and he wants to check to see if there's any enemy nearby. And he comes back and goes, dude, he goes to a sergeant or a squad leader or whatever, and look, there's an enemy camp right on the other side of the river. We need to go more upriver before we decide to cross. So that's what we call a scouter wick. The scouter wick goes out. The support and resistance line is so strong, it has a magnetic ability. That scouter wick reaches out with that magnetic pull to tag that trend line. But the trend line is so strong, it says, come on, I want you to tag me, but you ain't getting past me. All right. So it rejects that wick. That's a good sign of rejection. That's a good sign that that is a strong support and resistance. So when we have a trend line that's made up of two scouter wicks, that's not a normal 2-2. That's not a normal 2-hit trend line. And so what we'll do when we see that, and we've done this in our betas, when we see a trend line that's really strong because it rejected two scouter wicks, then that we can't give it a 3, but we're going to give it a 2+. Meaning it's not just normal 2 hits, it's above and beyond 2 hits. So a 2+ is very close to being a 3 in terms of how you need to see it. Okay. So it's still a 2-hit trend line, but with much more strength than a normal 2-hit trend line. And so here's an example of a trend line on scouter wicks. There's distance between them. We don't want 2 scouter wicks next to each other. That's not really a trend line. So there's distance between them. There's no other challenges with wicks anywhere close to what these two guys do. Both of them get solidly rejected. That's a pretty solid trend line, even though it's just 2 hits. So it gets a 2+ status. All right. So like at this point, I think I've covered everything that comes in the information in the alert. And now you know how to read these alerts. So we're good. So this will be the intro module to trading wedges with Wedge Plus. First thing you have to understand is what the alert is really saying. Now, there's some stuff I probably covered there that is, maybe a little beyond you in terms of things like harmonic scans, in terms of things like forks. Don't let that overwhelm you. We're putting that information on the charts for you to help you. And so you're going to get all this. Just have a little patience. Okay. But next week, we'll start off with the wedge standards, what we trade as a wedge, why we do it that way, what we can expect. And it's pretty cool because it's pretty tight. There's not that much associated with trading wedges in standard ways. I do have to apologize some. I notice a couple of you here and there were waiting in that waiting room. I'm not liking this thing. I've written Zoom yesterday trying to ask if there's a global override, if I can exclude it. Obviously, they've done it for security purposes. They put you in a waiting room first, and then the host has to add you from the waiting room, has to give you permission to come into the main room. So while it's a nice feature, while I'm in the middle of talking and I'm looking at the screen that I'm showing you and trying to explain things on the screen, I don't have eyes to see the waiting room. I don't have the RES yet. I haven't developed the habit of scanning it all the time. So if you have
Steve, you can turn on so it'll ding when they're waiting in the waiting room. I have the same problem. So if you go to the settings, you can make it ding when they're waiting in there.
Okay, cool. I prefer not to have one, but that's at least helpful. Draw my eyes to it. Yeah. So anyway, for those of you the past few days who had to wait a few minutes, I apologize, but that's what's going. That's a new feature that's just been implemented here in the last couple of weeks, and it's right now it's a nuisance. But I do appreciate it because it does give me a chance to see who's coming more than everybody just being in the room all at once. So it has always a Damocles sword. There's always a good side and a bad side to that sword. So there we have it. All right. Well, I thank you for showing up today. I appreciate that. You guys were very timely for the most part. I know we have work and sleep and, family obligations and church and hobbies and other things. And so we can't always be on time. Generally, the recordings for the sessions, depending on where they're going, will take 24 to 48 hours to be posted or available. And so a little patience with that. If you did miss today or you missed half of today or whatever, you had to cut out or you got here late. But I think this was an appropriate session to start off our wedge training with to understand the, I won't say complexity, but I will say sophistication of our alerts. We're providing so much information for you, both in data form as well as visually. And we're going to continue to do that as time moves on. So thank you once again. I hope you have a great day. And as always, remember, life can be short and sometimes even shorter than that. So for the people you care about and love, let them know you care about them and love them. Y'all have a great day, and we'll see you in a session sometime later this week.